Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth. How you doing out there? That's not my real voice. That is my finishing up the last of the Breckenridge Bourbon voice because, well, it's about that time of night and it's about that time of week where I'm like, oh boy, this is getting to be a little bit much. So much so, wow, it's bright in here. So much so that I would like to share some thoughts with data here tonight. Why is the stock market having trouble continuing higher? Do you know? Well, I'm going to give you a small and not so distant history lesson. We're going to explain it, and then I'll share the data with you and see if you don't agree with me just ever so slightly. Now, I've talked about this a little bit on our daily live show. It's called The Closing Beats, live on YouTube and Roku and stuff. Somebody takes it and puts it on there. But talked about it there, where money is leaving the stock market and going to the bond market. That's really weird because aren't bond prices really low right now? Yeah, that's kind of discounted there, right? Rates go up, bonds go down. But I want to dive into this a little bit deeper by actually sharing the difference with you visually and see if you can't determine that, hey, maybe the stock market isn't somewhere I need to put all my money. Now times that by the millions and millions and tens of millions of people all over the world that participate in the U.S. stock market. We are financial advisors here at Jazz Wealth. Hope you'll check us out. We are financial advisors that actually invest and manage our own clients' dollars instead of putting them in mutual funds and whatever they do. Side topic. I got a magazine. Nope, it's not here. I thought it was over there. So I got a magazine that's kind of geared towards the industry, and it ranked advisors by their earnings. These dudes make some money, man. So nonetheless, we are open for business, right? I'm like, geez, these guys are making lots of money, much bigger than us. But the difference here with us is we can't make more money unless you make more money. Our clients, right? So that's how we do it. We don't say, pay us $5,000 and we'll do something for you. No. If your account grows, then we get to grow too, and you're obviously happy by that. So that's how we're set up. You can check it out on our homepage. Side thing that just came to my mind. I'm like, you make what? Like financial advisors in my area too. Goodness gracious. Nevertheless, we do the real work for you. Okay, so the bond market, let's get down to it. What happened last year and the year before, and the year before, and the year before, and the whole decade before that? Could you invest in the bond market? You could trade the bond market, but could you invest as someone who wanted to buy a 1-year treasury or a 6-month treasury or 10-year? I don't know if that's your thing. You couldn't, right? Because prior to really like the last 9 months or so, if you were to have invested or bought a bond, your real return or your net return was actually negative. You get that? So what it was you'd have 1% for like the 1-year treasury, but inflation was creeping above 2 and 3 and 4 and then 5, and it went crazier. So while you held that bond and you got paid your 1% or 1.2%, you actually lost 6% to inflation. You see what I'm saying? So what the bond market refers to this to as your risk-free real return. Granted, you took no risk. There was no chance of you losing your money on that 1-year bond if you held it to maturity, but you lost as a net return. Well, now we have a very interesting scenario here. Oh, let me go back. So because that was the case, what did you do? You put the money in the stock market, right? So you're like, I can't make money in the bond market. I'll put it in the stock market. You took that risk. Well, the market was going up, so it was fine because all that bond money market was going on over here to the stock market, helping fuel those returns. People were chasing what was sort of a trailing 6%. If we focus on the earnings of the S&P in addition to the yield, you say, okay, that's 6%. I can't get that in the bond market. So I have to take risk. Very dangerous. What's going on now? If you pay any attention to the bond market, you know There's real money to be had over there. For the first time in decades, not decades, but at least a decade, there is a positive net real return. So you have a risk-free return of over 5%, and presumably inflation is creeping lower, and you'll have a real, actual positive real return. Not only that, you don't have to be involved in what happened last year in the stock market. You said, well, I don't like that. I need some safe money. I'm retired or retiring. So really interesting. Let's take a look at this here. This is the way I'm going to show it to you. The blue line, the light blue line, we're using the 6-month yield if you were to buy a 6-month treasury bill. So now, just to put this into perspective, the 6-month T-bill trades at over 5%. It's over here, 5.25%. As of when I'm doing this, it may fluctuate a little bit. Okay, and then I plotted the history of the 6-month T-bill as far as I could go. Then I said, okay, well, what happened last year? We had people chasing the earnings yield in the market plus the 1 point something that the stock market was paying in dividends, the S&P. And so I plotted that in blue. We're plotting the trailing earnings yield as a percentage, that is yield, in dark blue. Last year, we had more than half of the stocks, but this is not a joke, this is a true stat. Last year, we had more than half of the stocks, greater than 50%, right? So there's 505 stocks in the S&P 500. You can do the math. More than half of them were paying more, or had a dividend yield that was greater than the 10-year treasury, which should never be the case. And as you'll see, is not often the case. The 10-year treasury is what? Risk-free returns. But the stock market, granted risk, was offering a yield that was substantially greater than the 10-year. You couldn't invest in the 10-year. If you factor in earnings into the S&P, you had a 6% yield. Would you have 1.8 at one point? 1.7? Not even. So go back over here. Here's the spread I want to point out. This is the last sort of decade right in here. This is your 6-month T-bill. You can't buy it. It's 2% or less. Even much less than that, close to 0 at one point, and I think a couple times really right on it. Here's the S&P as a percentage of earnings. When that starts yielding over 6%, you say, well, I have to. I got to go do it. I can't put my money here. Even if it's yielding 4%, you can't get the money in bonds. You see what I'm saying? But now we have something really interesting happening. This incredible, meteoric, faster than ever in history rise in the 6-month T-bill puts you above the forward earnings, the trailing earnings of the S&P. What does that mean? You don't have to be in the market anymore. All of a sudden, you say, I don't need to take the risk. I can get risk-free returns over here. Think of everybody that is 55 and over. Where was their safe money? That money that we say, protect it. Don't bother with 3 years or 2 years worth of your savings. We don't want to take risk for fear of what happened last year. What could they do? Basically nothing, right? They had to go into a dividend fund, a dividend mix of a money market fund there. They had to do some different things. Really, really cool. Now, the reason I point all this out, and I'm going to wrap this up, the stock market has less money fueling it now because money is moving over into bonds. T-bills, bonds, notes, etc. It's moving over there. So therefore, there's less interest, not for it being a poor place to invest, but there's less interest over here because this is so much better and it's risk-free. It's what we say. So if you had to put safe money somewhere, you know you're doing just fine over here. Why risk it in the market? So when that happens, this is the cool part. What I did is I went back through the life of the S&P. And I said, anytime that's happened where there was a greater yield, and the way we kind of talk about it is, anytime the yield in the T-bill is greater than the trailing S&P earnings yield, let's see how the market performed. And then anytime it was the other way, let's see how the markets performed. Now, it's not bad news, just so you know. Here's what we're looking at. Here's the forward performance. And in the dark blue, this is when the S&P's earnings yield is smaller than the 6-month T-bill. In the blue, we have when the earnings yield, this is what happened just a couple years ago, earnings yield was greater than the T-bill, right? So we've got to put money in there. Start with the light blue. If the earnings yield in the stock market is greater than the bond market, by reference of the 6-month T-bill, in the 1-month performance, forward performance, average gains to 23.10%. 13.9. And I'm saying this, I should say it this way, outperformance of 23.1. So I'm not saying the market went up 23%. I should be clear about that. It is outperforming the market by 23.1 basis points, not percentage points. I think I just said percentage points. 3-month, we're outperforming the market by 13 basis points, 10 and so on and so on. That part doesn't matter to me. What's interesting is when the earnings yield of the market is less than the 6-month T-bill, we all of a sudden have underperformance. Still positive, I'm not complaining about this, but underperformance. Why would there be underperformance in the market? It's not because it's a bad place to invest. It's because there's another place I can put my money. Remember, there was a little time in like 2016 and 17 where it was more beneficial to be an international investor. They would say ex-US. So you would invest in the international emerging markets, however you chose to go about it, ex-US. So you would say, take all this out and go over here. There was a brief moment in time, kind of like value versus growth investing. There's always this brief moment in time where value outperforms growth and people get excited about that. It's not like that long term. Same thing here. There's a brief moment in time, however, it could be longer, where money is over here, shifting to the bond market. And day by day, people are saying, I'll go over here. Case in point, we have over 7,000 clients around the United States. You know what the number one question I get right now is? Dustin, should I go buy that CD? Should I go into a money market fund? Dustin, can you build something for me that's like a money market fund so I could just make like 4.5%, 5% on my money without taking any risk? Number one question. I can tell when things are happening like that because I have a big sample set, the client base. And I see them all doing that same thing. It's kind of like when something goes viral on TikTok, people go, Dustin, can I really write off 100% of my house, now 80% of a house if I buy a rental property and I'm a qualified real estate operator? Yeah, well, okay. I know you were on TikTok or Instagram, right? Everybody starts asking that. Trump's tax returns come out and everybody's like, you suck, right? And then all of a sudden I get the phone calls nonstop. Hey man, how do we do what Trump be doing, right? I get that question all the time. It's not a stupid question, but I could tell that. And so right now I can even tell our clients are saying safety, 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 but not for nothing. You know, I don't want 1%. I know I don't have to accept that anymore because the bond market's taken that. You still have money in the stock market, of course, but money can go over here. Because of that, we've pulled some of the energy out of the market. And that's what I really wanted to pull out, share with you here tonight. So I go a little over and above here today because tomorrow it's not going to be a Jazz After Dark. I'm sorry. I'll be traveling for a few days and I don't know if I won't be here, but I don't know if I'll be able to get to a point where I can get a video and upload it. So you'll have to just allow me a slight little early spring break. And I will be back, of course, next week to help you guys out. I do wish you a good rest of your week. Sorry, I'll be absent. And if you like what we're doing here, like, subscribe, that stuff. Show the support. Hey, show your support. I like that. I'm going to go with that. All right, you guys enjoy. Thank you for watching. Thank you for supporting us. And we'll see you next time.